Right, so today we saw something we haven't seen in a while. We actually had one of those rare down days. Was it a down day that's very typical of bullish intermediate runs? Was it a down day that can predict or have us looking forward to that intermediate pullback to begin sooner rather than later, kind of a warning sign? So I'm going to break that down in today's video, among other things, to kind of give us an idea of what we should expect from the market standpoint in the short term, knowing and that our expectations in the long term are still strongly bullish. But the sentiment indicators, as I've shown you before and today, suggest maybe a little bit otherwise. So I'm going to break all that down with today's trade idea, giving us something on the bearish side. We've been loading up on bullish trades lately in classes in our market outlook video. That this will give us something in addition to some of the other negative trades. This will give us another little small exposure, just in case, especially from this sector that we're going to be drawing from. So let's go ahead and get started. Today is Wednesday, December the 9th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast on the S&P 500. As you can see, a little bit of a bearish engulfing pattern today, engulfing yesterday's candle, but not that big of a drop. As you notice, at one point in time, because we came off the lows, at one point in time we had the momentum line in the lower reversal zone below 20. The near-term line also was down below 50, so we actually had a bullish intermediate confirmation signal briefly today at the lows, but then we bounced off of it and we were fine. So the near-term line actually still hasn't dropped below 50 yet. So we've had this nice, good near-term rally that started here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, which is 7 to 12 days is your typical near-term rally. You know, most likely it's going to cross below 50, depending upon how bullish you may be tomorrow. The momentum line didn't drop. It hasn't dropped in the lower reversal zone this whole time, this whole near-term rally. Whereas over here it had dropped to extreme lows and then obviously dropped to in the reversal zone during the intermediate pullback stage there multiple times. Just about every time it dropped in the lower reversal zone, to a lot of times to extreme lows during that whole period here of intermediate decline. Since we've rallied back up, it's been very brief. Only once have we dropped significantly low, and since on this current near-term rally, not at all. So the market sentiment line is rising. We're almost above 70 again. The intermediate line is strongly bullish, all the way up to the 97th percentile. So, you know, take any days like this with a grain of salt. We're not falling off a cliff. Today wasn't tanking. You know, it's hardly bearish. It just was a down day, a typical down day when you're in a bullish market. Now, can it lead to more? For sure. In fact, something I mentioned here before, you know, when you look at the gap, we didn't gap down like we did when we started the bearish run over here, the intermediate decline there. Even when we started the September intermediate decline, you can see we had a pretty significant gap to the downside after a pretty significant down day had established the weakness in the S&P and started the intermediate rallies, or decline, excuse me. So this was today's loss, not very significant at all, and didn't have a decline yet. The intermediate, you know, the VIX is rising, but the historical volatility is still very low. So take today's move with a little bit of a grain of salt. Not as bad as it probably seemed, especially on TV. You can see the Dow looks very similar. The NASDAQ looks very similar. In fact, the NASDAQ probably has the worst candlestick pattern as it fell below the past 4 days lows. So that kind of stands out a little bit. The Russell 2000 looks like it hardly fell at all. Its near-term line is still very strong. It did drop here below 50, whereas the S&P didn't during that time frame. But it's probably at the highest near-term level out of all these indexes, which again, I mean, when you look at how strongly bullish we are above the 30-day moving average for the Russell 2000, you know, it's still bullish. Like, we're still not getting significant declines or leaning towards any significant declines anytime soon. Here's the how far above the 30-day moving average we are. And if you just go back to like the last 5 years, we're in the 86th percentile of how far up above the 30-day the Russell 2000 is. Just to kind of give you an idea, I'm going to put this at current level so we can go back and compare it to now. So there's where we are now. In August, we got to a similar level. Obviously, in June is when we went parabolic on the Russell. And you can see all throughout 18 and 19, we never got this far away from the 30-day moving average. And this is a log scale, mind you. And if you go all the way back to late 2016, this was about as bullish as we got on the Russell 2000 after the election. And then we just went sideways for months, from early December all the way to mid-April. Very, very sideways action there. And for that matter, all the way through to August, once we had some ups and downs there in 17. So very, very flat after a very strong move to the upside like we're getting now, and we've had for pretty much now. It's not surprising that we had a big, strong move to the upside here because we're coming off a major low, but we're not coming off a major low now, and we still have a very significant. In fact, it's like I said, we've had multiple touches of this far away from the moving average, and we've been this far above the moving average now pretty much since a month ago. It's been going on a month now, so needless to say, a very strong bullish sentiment. Among other sentiment indicators I've shown you before, here's another one. This very, very strong sentiment right now in the small cap index and across stocks as a whole. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know, number one, that you liked our video today, and number two, that you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. We'd love to hear from you. If you don't like our videos, of course, you don't have to click on anything. Don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these things over here on the right, including our Market Outlook live video. I do one of these every day. I do the Market Outlook video. We review all the trades I've done in previous Market Outlooks to see how they're doing and see whether we should close them or not. I also put on today's trade idea before the market closes, so be sure to check that out. It's something I always get asked about. That's why we created that. It was one of the most requested things that people have been asking me for, at least. If you come down, you can see all of our trading rooms as well that are coming up here. You know, all of our subscribers, our monthly and our plus subscribers, our monthly and our premium subscribers all get access to those. The Q&A sessions are for our premium subscribers, so those are 2-hour-long Q&A sessions once a week, one for Brandon, one for myself, for all of our classes. That's a very fun, very popular class session available for all of our premium subscribers. Also, like our Market Outlook tweet and Facebook post as well. Again, the more that you do that, it benefits us because more people will see our Market Outlook posts because they're getting engagements. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here on our site. All right, now let's take a look at the weekly chart. As well, as you can see, higher high now since we got a higher high this week. Higher close on the Hakinyashi candle, no lower shadow, continuing to be very, very bullish. This is what after the transition here, 1, 2, 3, 4, 5. Last time we had a transition, we had 1, 2, 3, 4, 5, 6, 7, 8, 9 before things turned around. And of course over here after the transition, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And you can see some other longer ones over here. And I didn't actually expect this one to be as long because we didn't have very much. We never did test the 200-day moving average, and we just barely dipped our toes underneath the 23% retracement, where it wasn't very much of a pullback to say the least. And we're coming up off of a PPO low that's very high in and of itself. So ideally, you like to come off lows that are kind of in this area or lower, closer to zero. And that obviously wasn't the case here. So while there's, obviously this is a pretty decent intermediate run as it is, it's still on the shorter end of typical intermediate runs. I expect that will continue to be the case. It will be a shorter run with maybe another week or two, potentially heading into December expiration or at the end of the year here. Obviously we have green arrows except for the MACD. The MACD is rolled over. If you take a look at the two-line versions, you see what that looks like. It's got the MACD crossing below its moving average. Stochastics also crossing below the moving average, though both moving averages are very high, so take that with a grain of salt. Also, this decline got us down to the 8-day moving average. Obviously did not get us through the 8-day moving average, so plenty of room to the downside to test even the 17-day, which you typically have to do before the intermediate pullback starts, when you get a break below the 17-day moving average for multiple days. If you take a look at the Ichimoku Cloud trend strength indicators, we're still in a moderately strong. You notice we can't get going. We can't get this up above 5 on the trend quality, which again suggests how kind of flat and sideways we are. You also see that on the DMI. The positive index is dropping back below these levels, getting closer to 30. The negative index is looking to try to get back up above 20. As a result, the ADX just can't get going either. And that's what signals our directional move. So while we got the beginnings of a directional run here going before the election and after, it hasn't shown in some of these other indicators. Obviously, the RSI and the CCI are going to be rolling down. The RSI is still in bullish territory, but we'll see if that continues to be the case and if the CCI crosses below zero or not, because that's when you get the intermediate pullback is when it crosses below zero. If you look at the intraday chart here, you can see the decline breaking below the lows of the last couple of days, kind of filling in that little gap that we had from last week. Remember, this is the big one that we still have yet to fill in from early last week on Tuesday. So keep an eye on that. Very low volume below today's low point. We are obviously up almost $1 in the after hours trading, which is probably not the best thing. You'd prefer to be down in the after hours trading so you can fill in the gap with an upward move. That would mean a gap that would be filled in with a downward move. So we'll see by the time the market opens to see how that fills out. But there's a volume gap down below where we're at into the value area towards the point of control. That would fill in this gap. And of course, there's a few others over here as well that we'll see if we'll move down to lower support level would fill in some of those gaps or not down there. You can take a look at the at today's range and volume. The volume picked up for most volume we've had in a little bit. The range also picked up over above average range. So both those numbers make these start to bottom out just a little bit. The relative ATR bottoming out just a little bit before getting to the magic 1% mark. When you get below 1%, you really kind of get entrenched in a bullish move. From a volatility standpoint, we did rally up towards that 90% mark. A little bit of resistance in that area from a volatility standpoint. So we'll see if that plays out, or if we continue to go through the neutral zone into the bearish territory for risk appetite. Bullish for volatility, bearish for risk appetite up here. But obviously, the volatility moving as it did here today, trying to figure out and really still staying in the range. We talked about this range that we've been in the last few weeks, even with today's rally. It's still a very, very small range and still opens us up to the possibility of a coiled breakout type move, where we get this 1 week just crazy, crazy relative craziness, a 1 week pop, in volatility to whatever the level would be before we roll back over. So to summarize the technical outlook, a little bit of weakness today, but nothing, it's not trend-changing weakness. It's just a little bit of a pause. Yes, we have extreme bullish sentiment indicators. So yes, you would expect there would be more of an intermediate decline forthcoming, probably sooner rather than later. But I don't know if today is the day that starts it. We'll see how we follow up tomorrow morning, whether or not we get a significant gap to the downside that doesn't get filled in. So a runaway gap that would start the intermediate decline, or whether we, like we've already said, we are starting with a gap up to the upside. That probably, unless we really break down in the middle of the day, probably means that we're not going to start any intermediate decline with this drop, today's drop, and that it was nothing more than that, just a little bit of a short-term exhale that may have another day or two left in it before we make a little bit more of a shorter-term run to the upside. But remember, any moves to the upside, the risk, the potential moves are dampened and muted than they would be if we were coming up off a low, because of how strongly bullish we are, and how in the longer term, or the shorter term, and how the sentiment indicators are suggesting how bullish we are. So keep that in mind, that yes, intermediate posture is bullish, and we're going to continue on here for maybe another week or two or three, but I wouldn't expect it to go up very much. And when we do have the down days, they'll look like today, if not bigger, when we actually do start the intermediate decline. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. So what you're seeing that suggests why you're a lot more bullish or a lot more bearish than I am. All right, now let's take a look at how things performed here today. You can see here the strength, where the strength has been, and how things are moving and rolling over. And let's just take a look at here this week. So we'll go to December the 7th. And we'll go to like a 10-minute chart. So there's the weakness, and today obviously broad base across the board for equities, down in small cap stocks. In fact, let's just look at just today, so you can see today's weakness alone. There we go. You can see small caps down about 1%, large caps, emerging markets all down the most. Developed markets actually ended up positive by the late rally, because of the late rally. Commodity prices also ended up positive, despite a weakness in the dollar that really pressured gold. And you can see Qs struggling. As you saw, they had that bearish candlestick pattern on their chart. And let's take a quick look at gold here. So let me pull up this pattern here. You can see the rollover coming down from light green shading the yellow line. That usually signals strength in the dollar, even if the euro-US dollar has been kind of bouncing up. Now it's up today, but in the last 4 days the euro's been falling, which means the dollar's been rallying, coming off of that cluster. So you can see where strength is and where the weakness is, and it appears the dollar has been strong, has been weak, and gold has been rolling up. But now gold is looking to bounce off of a moving average to the downside, which would signal more bullish expectations for the dollar. You can see commodity prices are also pretty darn high, but pulling away quite a bit from the moving average, which means we might be a little overextended in that as well. But commodity prices and emerging markets are doing very, very well. In fact, if I go back out to a 20-year run on emerging markets to see where we're at compared to where we've been, and you can see we're still getting close to first of all the first quarter of 2018's highs, as well as over here going into the credit downgrade in the US a few months later. And then of course the late 1990s, our emerging markets did pretty darn well there, in addition to technology stocks. All right, now let's take a look at the sectors and look at their comparison here. And again, let's just look at here just today, like we did with the different asset classes. So come down here to December and just look at the 10th here. Sorry, it would be the 9th. And you can see again where the strength today was. Technology was down, communication services down, strength was in energy, industrials, materials, financials. Those are not the sectors we want to be the leaders, right? So they tend to be the leaders when we have some weakness there. And if I go out to the beginning of the week to see how they've done so far this week, again, they're the ones leading up right now. So as we've talked about before, market cap weighted indexes, when there's a disparity between the size of these sectors, then usually the market will run like the bigger sectors because they have the biggest influence on market weighting. Obviously, that would be technology, communication services, and healthcare too, as well, in addition to consumer discretionary. And they're the ones that are lagging right now, and everything else is gaining. So we have to take today's little strength, especially in the end of the day, with a grain of salt, because that's not the leadership we want us to lead us higher into any bullish moves. So if that's the case now, then expect this little bullishness in the after hours here to be short-lived and for us to maintain the bearishness that we've seen today. And that brings us to our trade idea of the day, and let's take a look at Salesforce here. Salesforce actually has a bearish pattern on its market forecast. You can see it's well below its moving average after its earnings announcement. And then kind of did a little bit of a dead cat bounce here over the past week before rolling back over today with a pretty bearish candle. In fact, if I take a look at it on a two-line version here and look at CRM, you can see it's came up to the 8-day moving average, rolled right back down, and you can see on the Bollinger Bands that there's a volume gap here. There's a little bit of volume node that we're kind of bouncing off of, breaking below and moving towards about 190, so getting just below 200. If you take a look at like it's let's look at the DMI, and you can see that we are well above 30 in the negative index, so well below 20, and you have a rising ADX. You would expect this trending move to continue. The trend strength indicator to the downside is getting to very close to strong bullish levels. And then finally, here's the RSI. Oops, excuse me. Let's pull up CRM. Here's the RSI, and you can see we're below 40. We stayed below 40 through this dead cat bounce. We're easily below zero, flirting with being below negative 100. All bearish patterns across the board. So that leads us to a bearish trade opportunity. Let's take a look. So what we'll do is we'll buy the 210 call option or put option. We're sitting at 220, so it'll be out of the money. It's down here. That's the one we're going to buy. We're going to sell the 200. So we have to get to 200 and stay down there at January expiration to get a maximum gain. So it gives us about a 3. Let's see. Let me get rid of the. There we go. That gives us about a 3-to-1 risk-reward ratio. And if it does keep going up and this pulls outside of the shaded area, then we can take out of 550, maybe a couple $100 loss, and give us a really good reward to risk ratio if that's the case. Of course, I can't position size around that expectation. You have to position size around the worst case scenario, but still doesn't mean that you can't anticipate the typical bearish scenario, and we can use that to close out the trade early. All right, well, that does it for today for us. For me, you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum where you can open up any new questions you have about any topics, anything I covered in these videos. And then you can also reply to other people's threads as well. That keeps this conversation going in our community. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video down below, as well as on Twitter and Facebook. Be sure to share your likes or share those posts in your timelines. Again, that the benefit, we talked about the benefits both for us and for you by doing so. So we really appreciate those that do. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.